Let us start this weekly executive strip for the date range November 24th, 2025 to November 28th, 2025 by looking at the big picture on the higher time frame chart for the index you see on screen. Overall, my bias for the coming week is sideways or slightly bullish, so I am not expecting a dramatic collapse or a runaway bull trend but rather a market that oscillates within a defined band. On the bullish side, we have a clear double bottom structure in the recent price action and what looks like a two-legged pullback inside a broader trading range. The market is holding support at the daily 50 exponential moving average around 6,500, and every time the bears have tried to push down there has been little convincing follow-through. Friday even closed right at its high of the day with very little tail, which is often a sign that buyers were willing to hold into the close instead of taking quick profits. On the higher time frame channel that you can see on the executive strip chart, the more flattened trend line drawn in purple is still intact, and as long as that line holds, the entire bullish case remains valid. A decisive break below that channel support would be the key signal that the bull story is in trouble. From the bearish perspective, price is still moving inside an obvious bear channel. That channel may still resolve as a bull flag, but until it clearly breaks to the upside, I have to respect it as resistance. The first major resistance above is the daily 20 exponential moving average near 6750, and the top of the current trading band is close to 6850. This week the weekly bar closed in what I call zone 2, the lower half of the weekly range, and there is still a gap left open below 6655 on the weekly chart, even though that gap has already been filled on the daily chart. Looking ahead into December, a direct straight line collapse looks unlikely, but a straight line resumption of the bull trend also does not look realistic. Instead, I expect mostly sideways and choppy trading before Christmas, with a very high probability that the entire December range stays between 6236 and 6850. For the coming week, I am focused on a working range from 6500 up to 6850. Losing 6500 is possible, but in my view a low probability event. Soft resistance comes in around 6750 at the daily 20 exponential moving average. Hard resistance sits near 6850 at the top of zone 1 and the top of the bear channel, and support is anchored around 6500. A clean break and close below 6500 would seriously damage the bullish fundamental setup and could lead to a mid-term correction that lasts for months. One extra layer this week is macro data, with both gross domestic product and consumer price index releases scheduled on Wednesday, so we should be prepared for spikes in volatility around that session. Translating all of this into concrete trade planning for next Monday, if we open with a gap up or roughly flat and the first bar closes at its high, I am comfortable looking for a long with a daily profit taking target around 6700. If instead we open with a gap down, there is a high chance that the market will retest the 6550 area. Bears will need to show very strong momentum to push through, because 6500 has been strong recent support and is not easy to break. Only a clean break and close below 6500 would tell me that the bullish foundation has been damaged and that a mid-term correction is probably underway. So that is the quick executive overview for the week ahead, and next we will zoom out to the monthly outlook to see how this fits into the longer-term picture. Moving on to the monthly outlook, let us step back and look at what the current bar is telling us in the context of the bull market that has been running since April on the higher time frame chart you see here. For December, my bias is mildly bearish, not in the sense of a new secular bear market but in the sense of a market that is digesting a strong prior advance. The index is still trading inside a tight bull channel on the monthly chart, and that structure has been in place since April. Even if the entire December bar eventually closes as a bear bar, that would still leave the long-term bull trend intact. In other words, a sharp violent sell-off from here is unlikely, and any pullback that we get is more likely to be a pause within the larger uptrend than the start of a major top. The current move down is best thought of as a deep pullback inside the tight bull channel rather than the first leg of a broad top. With only 1 week left in the month, there is now a high probability that the November monthly bar will close below its 50% midpoint level. That sort of close usually confirms that the market is in a short-term correction phase, but it does not, by itself, reverse a strong long-term trend. Price is still well above the monthly 20 exponential moving average, and the odds of a correction that works back down toward that average are increasing. Importantly, that moving average more or less lines up with the February all-time high breakout zone, so a dip toward that area would be a natural place for longer-term bulls to defend the trend. It is quite reasonable to expect that process of mean reversion toward the monthly 20 exponential moving average to extend into January or February rather than completing in just 1 or 2 weeks. When we look at the prior price action, we can see that before this current pullback there were 6 consecutive strong bull bars on the monthly chart. In the framework of Al Brooks and many other price action traders, one bear bar, no matter how large, does not end a bull market that has produced 6 solid bull bars in a row. Aggressive buyers are very likely waiting below current prices, ready to add to positions if the market pulls back into perceived value areas. That is why I keep the long-term conviction firmly bullish even while I respect the short-term downside risk. At the same time, the probability of a retest of the February all-time high breakout area keeps increasing. The backdrop here includes macro uncertainties such as the future path of interest rates, signs of a softening labor market, and widespread overvaluation in risk assets, especially in the mega-cap technology space. Those forces can easily drive a deeper but still normal pullback toward prior breakout levels without actually killing the bull trend. In terms of concrete levels to watch on the monthly chart, the resistance zone sits between 6850 and 6900. Given the current pullback and the time left in the year, making a brand new all-time high in December from here looks extremely unlikely. On the downside, 6236 is the key level. That price marks the February all-time high breakout area and functions as the main long-term bull market defense line. As long as the market stays above 6,236, any dip into that area is still consistent with a healthy ongoing bull. Only if we were to see repeated closes below 6236 would the character of the market start to change in a meaningful way. So the monthly picture is one of a strong bull market going through a deep but so far normal correction, and that gives us the backdrop we need as we drop down to the weekly outlook and think about how the next 1 to 2 weeks may unfold within this larger structure. On the weekly outlook, I want to connect that higher time frame story with what happened over the past few bars and what that means for the coming week. The trend on the weekly chart is best described as sideways to mildly bullish. Short-term, the bias is in the process of shifting from bearish back toward neutral or even slightly bullish, but the transition is not yet complete. If you look at the weekly chart on screen, you can see that price is still moving within a bear channel. However, that channel sits inside the larger bull context we just discussed, and it is much more likely to resolve as a bull flag than as the first leg of a multi-month bear market. In other words, this pullback is probably a pause inside the uptrend, not the start of a long enduring downtrend. A key observation from last week is that the weekly bar closed below its midpoint, so on its own it does not look especially strong. At the same time, Friday on the daily chart was a very strong bull day. That combination of a weak-looking weekly close paired with a strong final session is a classic setup for a shift in sentiment. Often traders come into Monday still thinking in bearish terms because they see a series of down weeks, but the strength of Friday makes it easier for buyers to suddenly take control. At this point, we have 4 consecutive bearish weekly bars. Statistically, that pattern does favor continuation, at least on paper, because trends tend to persist. But when we drill down to the daily time frame, the structure is increasingly supportive for the bulls, with double bottom patterns and 2-legged pullbacks that look more like a trading range than a sustained bear trend. That daily strength suggests that the move down in the weekly bear channel is either exhausted or already over, and that is why I lean away from the idea of a powerful new bear leg from here. Another important feature is the role of the weekly 20 exponential moving average, which has been acting as support. Last week that level held, and there is a high probability that we will retest it and see it hold again. The odds of a decisive break below that average, followed by strong selling and a new sustained bear trend, remain low for now. Instead, I expect a high chance of 1 or even 2 weeks of sideways range-bound action clustered around the weekly 20 exponential moving average zone, which on my chart corresponds roughly to the 6480 to 6550 area. That zone is where I expect a lot of two-sided trading, with both bulls and bears active but neither side getting clean follow-through. In terms of levels to watch in the short term, 6,800 remains the obvious upside objective for the bulls. If buyers successfully defend the 6480 to 6550 support band, the top of the current channel around 6,800 is the natural target where profit taking is likely. On the downside, I am looking for strong buying responses whenever price trades down into 6480 to 6550. The probability of sustained trading and repeated closes below that support area is low given the broader bull context. So from the weekly perspective, I am preparing for choppy two-sided trading around support that eventually resolves higher towards 6,800, and with that in mind we can now zoom in to the daily outlook to fine-tune expectations for the next few sessions. In the daily outlook, we bring the focus down to the bar-by-bar structure that will drive actual trade decisions in the coming sessions. Right now the daily trend is neutral to slightly bullish, which fits neatly with the sideways to mildly bullish tone we just saw on the weekly chart. The most important pattern is a clear double bottom on the recent daily lows. Rather than a clean bear trend, we are seeing a two-legged pullback inside a larger trading range, and price is currently sitting at the bottom of that range with help from the daily 50 exponential moving average. That average around 6,500 is acting as a cushion, and buyers have been willing to step in each time the market dips into that support. To understand the bigger picture, it helps to recall that since breaking the previous all-time high on June 26, the market has shifted from a tight bull channel into a broad multi-day trading range. In environments like this, direct and immediate full reversals are rare because market inertia keeps pulling price back into the middle of the range. That is why I am cautious about chasing either extreme and prefer to think in terms of buying low and selling high inside the range. At this stage, the overall setups favor the bulls more than the bears, especially when we connect the daily picture with the weekly executive strip we discussed earlier. The double bottom and the two-legged pullback lean toward at least a test higher, even if that move turns into just another swing inside the range rather than a sustained breakout. For medium-term bulls, the key question is whether this structure will lead to a true resumption of the bull trend or whether uncertainty will persuade many bulls to shift into scalping mode, taking quick profits and thereby allowing bears to engineer a deeper retest of the old all-time high area around 62.36. My own stance is to be comfortable holding longs on a short-term basis while keeping plenty of mental and positional room for bears to push the market lower again over the coming months and to retest that prior breakout zone. For the near term, meaning the next week or so, I see a slightly bullish or sideways bias as the most likely outcome. With Christmas approaching and liquidity gradually thinning out, a deeper pullback toward the 62.36 old all-time high remains possible later in December, but it is not my base case for the immediate few sessions. The key levels on the daily chart mirror what we have already discussed. On the upside, the daily 20 exponential moving average, which sits near 74.70 on my chart, acts as a soft area of resistance. Given the bullish setups around the double bottom, the odds are low that this average will cap the price for long, and it should be relatively easy for the market to break above it if the bulls are as committed as they appear. Beyond that, the 6,800 level remains the primary weekly upside target and the natural place to look for a reaction from bears who want to defend the upper boundary of the recent structure. On the downside, the 64.80 to 65.50 area, which combines the bottom of the trading range with the daily 50 exponential moving average, is the main support zone. Strong buying interest is expected whenever price dips into that band, and the probability of sustained trading in repeated closes below it remains low as long as the larger bull market stays intact. So with the daily context framed as a trading range tilted slightly in favor of the bulls, let us now turn to the 5-minute charts and review how last week's intraday action played out starting with Monday. Now for the 5-minute review of last Monday, I want to walk through how the day unfolded using the Al Brooks price action lens and how that matched the game plan from the weekly outlook. The day began with a clear gap down on the open, which immediately put the market in an always-in-short posture and confirmed the idea from the prior outlook that we would be looking to sell if a proper bear setup appeared. Early on there were smaller swings and counter-trend attempts, but the structure was still that of a sell the rally day. The key opportunity came at bar 37, which on the chart you see here formed a double top step pattern. In Al Brooks terms, this is where the market makes a new swing high just above a prior high, stalls, and then produces a strong bear signal bar that invites traders to sell. At that moment the bars leading into the signal were relatively large and clearly bearish, which told me that the sellers still had good momentum behind them. Entering short below bar 37 aligned perfectly with the overall bias to continue lower after the gap down and gave a clear place for a protective stop above the recent swing high. From there the structure allowed for a one-time measured move objective that projected down into the area around bar 64. The idea behind that measured move is simple. You take the height of the previous leg down and project it from the high of the pullback that ended at the double top step. When you see the market respecting that geometry again and again, you can confidently hold a swing short rather than grabbing quick scalps. Of course, in real time there is always noise and some counter-trend buying, but as long as the pullback stayed small and the bear bars remained relatively large, the path of least resistance was downward toward that bar 64 target. Last Monday is a good example of a day where the best money was made by recognizing the always in short context early, being patient enough to wait for the cleanest signal, and then giving the short room to reach a reasonable measured move instead of exiting at the first sign of hesitation. With that review of Monday in mind, we can now look at Tuesday, which turned out to be a very different type of session. For the 5-minute review of last Tuesday, we again start with the open, which produced another gap lower. Given the bearish context from the prior days, taking a short early in the session made perfect sense and bar 3 provided that opportunity. Selling below bar 3 with an initial objective at the bottom of zone 2 was consistent with the plan for a continuation day, where the market would open weak and then continue to grind down. However, the market had other ideas. Instead of giving clear bearish follow-through after that early short, the session quickly morphed into a tight sideways range. In Al Brooks' language, the day shifted from a potential trend from the open into a trading range day where both sides were repeatedly disappointed. For anyone who took the bar 3 short and managed it with a trailing stop, the lack of downside progress meant that the stop would probably have been hit somewhere around bars 24 or 25 once the market rallied far enough back into the range. That is exactly the kind of environment where swing traders tend to get chopped up while nimble scalpers can still do reasonably well fading moves at the edges of the range. Later in the day, the character of the price action changed. Downward momentum had clearly stalled, as evidenced by overlapping bars and failed attempts to push to new lows. Price was retesting a rising trend line from below and the market failed to make a fresh low on that test. In that context, going long at bar 37 made good sense. The idea was that a rally from there could unfold into either an AB equals CD type pattern or a simple one-time measured move to the upside. Both of those targets were logical within the framework of a market that had shifted from trending lower to oscillating within a range. The challenge, as so often happens in real time, was that neither the short from bar 3 nor the long from bar 37 played out cleanly enough to do more than scalp. For most swing traders, this would probably have been a losing or at best a break-even day after slippage in commissions, and it serves as a reminder that trading range days are designed to frustrate. Importantly, what was supposed to be a strong bearish continuation session instead turned into a non-trending sideways grind, and that change in character significantly called into question the strength of the prevailing bearish momentum going into the middle of the week. With that shift in mind, let us look at Wednesday and see how the market followed through. Wednesday's 5-minute review continues the theme of a market that was refusing to reward directional conviction. After Tuesday's failure to deliver a clean bear trend, the big question coming into Wednesday was whether the market would now transition into a sustained bull day or remain stuck in a range. Buying the open was entirely reasonable and fully consistent with the idea that the disappointment on Tuesday had weakened the bears and set the stage for a move up. On the chart you can see that the early bars on Wednesday did offer some bullish setups, and in the Al Brooks framework this was a classic attempt at a trend from the open in the opposite direction of the prior move. Unfortunately, that attempt never gained real traction. Instead of a strong series of bull bars with only small pullbacks, the price action quickly degenerated into yet another sideways range with overlapping bars and constant back and forth movement. There was virtually no follow-through in either direction. Every time buyers seemed to get a breakout going, the move stalled and reversed. Every time sellers appeared to regain control, the downside push failed to extend. For swing traders who were trying to hold for a meaningful move, this was an especially frustrating session. Many of the buy entries that looked good initially would have pulled back enough to trigger stops or forced uncomfortable decisions to scratch at small losses. By the end of the day, most positions were likely closed either slightly negative or at best around break-even once slippage and commissions were taken into account. This is a textbook example of a limit order type market where it is very hard to make money with stop entries and wide targets, and where the only traders who do well are those fading moves at support and resistance for quick scalps. From a learning standpoint, Wednesday reinforced an important Al Brooks lesson. When you see 2 days in a row with poor follow-through, lots of overlap, and no clear trend, you have to downgrade your expectations for swing trades and accept that the week may be dominated by trading range price action. That context is essential for interpreting what happened on Thursday when the market finally did deliver a large move, but in a way that was still tricky to manage. Thursday's 5-minute review shows how quickly a market that has been dull and range-bound can suddenly produce a dramatic move, and how easy it is to underperform even when your directional read is correct. The day opened with a large gap up that carried price directly into the major resistance area around 6,800. From a fundamental and structural standpoint, shorting that open made a lot of sense, provided that a clean bearish setup appeared. The pre-market rally looked exaggerated, and when you placed it in the context of the overarching bear channel on the higher time frame charts, the idea of a reversal down from resistance was very attractive. In Al Brooks terms, the stage was set for a possible trend from the open down day. What caught me off guard was the sheer strength and speed of the downside follow-through once the market turned lower. Instead of a gradual drift away from 6,800 with pullbacks that offered clear add-on points, the market plunged almost straight to the bottom of Zone 2 with virtually no pause. It was one of those rare days where the selling pressure was relentless and where traders who waited for textbook pullbacks simply never got a second chance. I did take the short, but I managed it too much like a scalp instead of treating it as a potential swing in a strong trend. By closing the position manually along the way, rather than trusting a trailing stop to do its job, I ended up capturing only a portion of what a patient swing approach could have delivered. This turned what should have been a standout trend day winner into a much smaller profit. The lesson from Thursday is that when the context points to a high probability of a strong move, especially from an important level like 6,800 in the presence of a bear channel, it can pay to tolerate more noise and give the trade room to run. In Al Brooks' language, this was a trend from the open down day that offered a rare opportunity for a big reward relative to risk, and the main mistake was treating it as just another choppy session. Keeping that in mind, we can now turn to Friday, which showed the opposite picture with a major trend reversal up from support. Finally, let us review last Friday's 5-minute chart, which provided a cleaner example of a major trend reversal pattern and a strong day for the bulls. On the higher time frame, price had already reached a major support zone, so coming into the session it was perfectly reasonable to expect that a long opportunity might appear. The open helped to confirm that idea. The market gapped up, then pulled back to retest the gap, and that retest held. In the Al Brooks framework, a successful gap test followed by a clear higher low is often the seed of a major trend reversal. On this day, that higher low was visible around bar 20, and buying above that bar gave a high probability entry for traders looking to catch the turn up from support. A more conservative trader could even wait for a break above bar 2, which still offered a favorable entry but with a bit more confirmation that the bulls were seizing control. Once the reversal was underway, managing the trade with a trailing stop would have preserved most of the gains as the move unfolded. Bars remained mostly bullish, pullbacks were shallow, and the structure had the look of a steady trend day up. The theoretical measured move target around bar 63 was reachable in hindsight, based on projecting the size of the first leg of the rally, but it is important to be realistic about what most swing traders can capture. In practice, the market rarely moves in a perfectly straight line, and a trailing stop will usually take you out before the absolute high, especially if you are tightening it under each new swing low to reduce risk. Even so, Friday was a satisfying session because the major trend reversal pattern behaved broadly as expected. The gap up, the successful retest, the higher low, and the steady follow-through all fit the textbook description. More importantly, when we put Friday together with the rest of the week, we can see a market finding support at a higher time frame level and starting to transition from heavy selling pressure into more balanced two-sided trading with the potential for a new leg up. That sets the stage for the coming week within the broader bullish backdrop we outlined at the start of this outlook.